China's history spans several millennia and is rich in success and tragedy alike. From the Shang dynasty in 1250 BCE, the Bronze Age, with the evidence of developed literature, including poetry and the practice of divination, and then on to the single-state rule in the Qin dynasty in 2021 BCE, and from which era came the Terracotta Army, and on to the Tang dynasty from 608 to 907, which was probably regarded as China's golden age due to developments in science and technology, economics, poetry, and geographical influence. Another highlight was the Song dynasty in 960 to 1279, another golden age with inventions such as the hydromechanical astronomical clock, woodblock printing, and paper money, as well as advances in warfare which took gunpowder discovered in the Tang dynasty and turned it into new firearms and siege weapons, although actually military power was actually weak. The Ming dynasty in 1368 to 1644, which was really the age of where the modern Great Wall we know today was formed, was notable for urbanization, with Nanjing and Beijing being centers for private industries in paper, silk, cotton and porcelain. Foreign trade increased at this time despite the deeply rooted xenophobia, and China saw many visitors from the Western world in the Age of Discovery. Interspersed in time, China has also times of disaster and suffering, including various invasions, including the Mongol invasion in the 13th century with Genghis Khan, the century of humiliation, the Opium Wars, and China's Great Famine, to name just a few. No one can deny that China has had a meteoric rise in the past 30 years. Will the history books call this another golden age? But the road ahead is far from clear, and the most recent years' numbers have questioned whether China can sustain its success. As investors, let's look at where China stands right now and whether China still deserves a place in our portfolios. Welcome to another episode of Money Matters. A quick note before we start: in aiming to make this video last longer than just a few days, I want to take a more medium to long-term perspective on looking at China and how we view the region or market as investors. Far too often investors are myopic in their thinking and get sucked into the financial misinformation that bombards us on a daily basis. So, with that in mind, let's proceed and look at China's distant horizon. Only 50 years ago, China was a nation of factory workers and farmers whose main means of transport was the bike. And although economic activity was buoyant and China opened up to the outside world, it was still considered an inconsequential player on the global stage. Its GDP was a measly 178 billion USD, and GDP per capita was worse at $184. This pales in comparison to the US with a GDP of 2.6 trillion and GDP per capita of nearly 11,700. The average American having over 63 times the spending power of the average Chinese. And despite the tragedy of the Great Famine, the 70s was actually a great time of great prosperity for China. Its economic growth was staggering. In the 80s, it was a time of great change, and Deng Xiaoping gave the Chinese people their first glimpses of the outside world. There was optimism and a newfound sense of prosperity. China became the factory to the world. There were major plants for key industries. China became famous for making cheap toys, but actually it was producing large quantities of coal, construction materials, and leather. Subsequently, energy use increased dramatically, and energy supply became a problem, limiting factory output to around 70 to 80%. Coal remained the primary source of energy, accounting for around 70% of total energy use in 1985. China had the world's 7th largest capacity to produce electricity, yet it fell short of demands, creating a bottleneck for economic growth. Technology advancement was behind that of the West and Japan, its factories producing electrical goods that were about 10 to 15 years behind the world's best. Separately, the 80s saw the beginning of the one-child policy. From there on, China experienced social and economic reform, and through economic liberalization, globalization, and investment in infrastructure and education, its GDP grew at an average annual rate of 9.5% between 1979 and 2018, according to the World Bank. We all know now it is the second largest economy in the world. It is the largest trading partner to over 120 countries. It is a major influence on the world stage, with strong ties in Latin America, Middle East, Russia, Africa, and Southeast Asia. It has secured much of the world's precious natural resources, built major infrastructure projects for other developing nations with a trail of debt, supplies much of the world's consumer goods with approximately 28.7% of global manufacturing output, the US in second place with 16.8 and Japan third with 7.5, and with GDP growth expected to be around 5.2% according to the IMF, in comparison to advanced economies expected to deliver only 1.3% GDP growth. It is also the third nation ever to send a human into space in 2003, and it has been expanding its space program ever since. Now it has its own satellite global positioning system called Beidou, and this reflects China's intention to decouple its technological research and development from the West, choosing to develop its own technologies. And some would argue this is a detrimental move. Time will tell if it pays off in the long term. It is currently behind the curve with homegrown semiconductor chips, China investing hundreds of billions into its state-owned enterprises such as SMIC and YMTC. So far, it has been an endless money pit. Currently, only a fifth of chips used in China are manufactured in China. Taiwan, the leaders in this field, is siding with the US and securing them a steady supply of chips in the years ahead, building new foundries in the US and Germany to increase its production capacity for the decades ahead. See my video on why chips is the new oil. However, its most recent years have left many to question and doubt China's future. Its population is experiencing a reduction for the first time since 1961, which is actually unwanted despite the central government's one-child policy. It is experiencing deflation, signaling a warning to its economic prospects, industrial output and investment falling consistently, youth unemployment now above 21%, with many more in unsecure jobs earning unreliable income. There's no hiding from the fact that China is experiencing significant headaches going forwards. And most recently, the central government is deciding to withhold some information on unemployment rates and other key data relating to China's economic performance, inviting more criticism from the Western governments and the press. On the subject of the Western press, the Western governments generally have rather dim views of China, criticizing its authoritarian methods, its human rights violations, its various cases of cross-border intelligence gathering, to name just a few. From a market's perspective, the latest developments bring us back to the real estate sector, with Evergrande applying for bankruptcy and now Country Garden defaulting on its bonds. There is a genuine fear that the debt will spread throughout the banking sector and possibly beyond. Is the central government just dealing with a hangover from COVID? Or is it fighting a lasting decline in its economic growth and the good times are now ending? What can the central government do to turn things around? What tools does it have at its disposal? For a long time, China has been strategizing on a global scale, forming alliances, developing joint ventures, promoting cross-border trade. It joined the World Trade Organization in 2001, becoming its 143rd member following 15 years of accession negotiations. This was a major move and triggered structural reform and dynamic growth thereafter. It had gained access to a multilateral trading system, connecting it with 1.3 billion producers and consumers. Since China's accession to the WTO, the government gradually opened up its financial sector and reduced barriers to foreign entities operating in China. Since the turn of the century, China has undertaken a process of financial liberalization. One of the ways this has manifested itself is by China opening up itself to foreign financial institutions. The administration of foreign-funded financial institutions was passed at the 50th Executive Meeting of the State Council, and it came into force in February 2002. This meant that requirements on foreign financial institutions were relaxed, enabling foreign banks to expand into China. This also opened the door for insurance companies and securities companies, and later on in July 2007, exchanges such as the New York Stock Exchange, Nasdaq, Tokyo Stock Exchange, and Singapore Stock Exchange were allowed to set up their offices in mainland China. The Belt and Road Initiative is a global infrastructure development strategy devised by the central government in 2013 to invest in more than 150 countries and international organizations, and probably considered a centerpiece of Xi Jinping's foreign policy. The BRI forms a central component of Xi's major country diplomacy strategy, which calls for China to assume a greater leadership role for global affairs in accordance with its rising power and status. Picture it this way. For many decades, the popular kid on the global playground has been the US. Every nation wants to be its friend and trade with it. But now China is saying, hey, come trade with me instead. Let's make friends and prosper together. And obviously the US doesn't really like that. Cue the political strategy and many trade sanctions. China is desperately trying to bolster its economy. I think it surprises the central government just how bad things are getting. I've said before, they do have room to maneuver in the fiscal and monetary policy. The China prime rate stands at 3.45%, having just been lowered from 3.55 to 3.65 recently. The central government seems reluctant to make bigger cuts, but there's still the capacity to do so. The corporate tax rate is at 25% and down from 33% in 2008. For context, the US corporate tax rate is at 21% and down from 35% in 2017. Perhaps an insignificant but symbolic reduction may bolster the Chinese economy. Or maybe the market may read this as a sign of desperation or economic weakness. Who knows? But they do have the tools at their disposal. Despite the terrible market sentiment, partly to do with China's dreadful PR machine and Western media coming down hard on China's every move, many asset managers, including myself, agree that Chinese stocks are technically and massively undervalued. But I refer back to the quote I often, quote, "Markets are irrational at the best of times and humiliating at the worst of times. Quantitative analysis alone cannot predict the markets. If they can, then we'd all make a lot of money. Sentiment or human behavior adds a huge measure of unpredictability to the forecasting. It is sentiment that is holding back Chinese stocks, and this sentiment is reinforced with further bad news in the press." Is there light at the end of the tunnel for China? I believe so, but patience is key. Remember that the news we receive is largely priced into the markets, so don't react on fast news, don't binge on fast news. Read full-sized reports from different experts and from different angles. Develop your own theories and apply them to your own strategy. No one else's, just yours. If your investment thesis is sound, continue with conviction and remain steadfast. Will I continue to play a part in the China story going forwards? Certainly. You have to make up your own mind. I wish you prosperous investing and good fortunes. Thank you for joining us on this episode. Let us know what other topics you would like to hear about. Give the video a like if you liked it and subscribe to the channel. And I'll see you on the next episode of Money Matters.